Hello, I'm Monene Watson, CIO of Old Mutual Multi-Managers. Hedge funds have become topical of late, and today I'm joined by Busi, who looks after hedge funds and portfolio management of hedge funds in our business. But Busi, before we move on to the questions that I think people are interested in terms of hedge funds, I just want to note that Old Mutual Multi-Managers have been running a hedge fund of funds for many, many years. We've won the 10-year award for the best risk-adjusted hedge fund of funds in the industry for 4 years running. So that speaks to consistency of returns. It's like a rolling 10-year award in a sense. So Busi, I know you're very passionate about hedge funds, and it's an area that people have had mixed feelings about for many years, and we'll speak to some of the issues of why that's the case. But I think we should just start off at looking at hedge funds and how they've performed versus other asset classes within, our market, our local market.
Yes, thanks, Monene. I mean, if you just think back to the year to date in terms of returns, I mean, we all know that it's been quite a roller coaster ride across markets, not just locally, but globally. And hedge funds really tend to thrive in that environment. I mean, we saw last year where hedge funds posted stellar returns compared to local asset classes, including equities. And we have seen that continue year to date as well. And for an example, the latest figures, if you look at equities, I think the latest is that equities are down in the tune of 10% year to date. And if you look at our fund, for an example, our fund of hedge fund, it's still showing positive returns in that kind of environment. So this is not only compared to equities, Monene. If you look at other asset classes as well, if you look at bonds, you look at cash, our hedge fund and the broader hedge fund industry has really posted stellar returns relative to these asset classes year to date. And this is really because hedge funds have extra tools to express their views on the market. So whereas with your long-only counterparts or the traditional asset managers, they can only really make money from buying shares that they believe will go up in value over time, hedge fund managers can also buy shares sell shares that they believe will go down in price, right? And for an example, if you just look at June, the month of June, equities were down north of 7% in June. And in that environment, hedge fund managers, and specifically our fund, posted a negative 1% return in that environment. So that really talks to the capital preservation element that hedge funds bring in. And you also note that most of the outperformance that hedge funds tend to generate over time is posted really during these periods where there's increased volatility in markets due to the uncertainty that is at play globally and locally. And therefore, because hedge funds can actually also make money in a falling market, they are able to post those positive risk-adjusted returns relative to other asset classes.
Thanks, Busi. So it's that flexibility around the mandate and how you can manage risk and opportunity that makes hedge funds different. And we've included our hedge fund managers within our institutional funds for quite a long period of time. It's been beneficial in terms of the diversification that it has provided on a net of fees basis. We're looking at providing a standalone solution on the retail side, and hopefully we'll be able to speak about that in the next few months. But Busi, I want to get to the topic that I think is sometimes, front of mind for people when they're thinking about hedge funds. And that is the question of fees. When we're speaking about returns, we're always speaking on a net of fees basis, but people look at TRs, they look at the fees, and that's a worrying aspect for them. How would you suggest that people think about the fees, and what have we done in terms of managing that from our side?
Yeah, no, certainly, Monene. Fees are definitely a key consideration, and I think it's actually been a key deterrent as well, just in terms of investors allocating money into hedge funds. And I also think it's because historically, hedge funds really were charging the 2 and 20 fee structure, which means the base fee is 2% with a performance fee of about 20%. And what's happened over time is that that's actually come a long way in terms of coming down. That's come down quite a bit. And over and above that, we have also managed to, like you were saying, negotiate much lower fees for our clients. So from a fee perspective, hedge fund fees have come down quite a bit. But even with that, I think, like you said, like you also mentioned, when we quote performance, it is net of fees. And for an example, what I just quoted now is just year to date. If you look at our fund of fund performance over, let's say, the past 10 years, we actually net of fees posted a 2%, north of 2% alpha compared to equity markets, and doing that at much
lower levels of risk. In actual fact, less than 50% of the risk that equity markets generated their returns on. So on a risk-adjusted basis, you really get proper value for money. So not just the outperformance, but also just the experience or the ride with the hedge fund experience is a lot less volatile. So Monene, I would say that for clients, while fees are a key consideration, one needs to look at the value for money aspect of it as well, because I really think that it's a lost opportunity, like what we have seen year to date. So our clients or our investors that have exposure to hedge funds have definitely been cushioned from the full impact that equity markets have felt year to date, with the negative returns that we have seen. But with that, including that in one's portfolio, definitely improves the overall diversification of the portfolio and the risk-adjusted returns over time.
Thanks, Busi. And that speaks to this whole thing of value for money. And I mean, part of that is the way we've structured fees in a way that we feel is fair to all parties involved. But I think what is important to also understand when we say value for money and where our conviction in hedge funds comes from, it's partly because we see the industry as being fairly mature. I think for people who aren't familiar with hedge funds, it might feel like something new. Can you just give us some insight into how mature this industry is, what kind of track records managers have, that this is not a new thing that we're suddenly talking about?
Yes. I mean, the industry is almost 30 years old, Monene. And the very first hedge fund was actually launched in 1995, right? And if you just look at our fund of hedge fund, that was launched in 2003. That also means that we're also coming up to two decades, in terms of managing fund of hedge funds. And so, and overall, it has matured. The overall industry has matured and formalized quite a lot since then. Today we speak about hedge funds being regulated, by CISCA and regulated alongside the unit trusts, or CISCA, which regulates the local unit trust industry. And that really just means that hedge funds also benefit from the independent oversight that, every other unit trust in South Africa enjoys. So that's quite positive in terms of investors, because it should provide investors with that comfort that, compared to what the perception has been around hedge funds, that, they're risky and all of that. But at least there is that independent oversight that's available, and looking after the risk side of things. And then secondly, if you look at just in terms of assets, hedge fund assets sit, in the tune of around 80 billion rands, and depending on the source that you're looking at. And the one thing that I want to highlight is the extensive experience that our local hedge fund managers have in managing hedge funds. And as such, the success that they've enjoyed in managing hedge funds, like we've spoken about, is also due to that experience that they have in the area. So, for example, if we just look at our fund of hedge funds, our underlying managers, the range of experience there, specifically in hedge funds, ranges from 13 years all the way up to 24 years, right? And on average, that sits at around 17 years. So, there is a really strong and robust, teams that are managing money on behalf of our clients. And that's what also gives us comfort in terms of allocating to them. Like I mentioned, the 80 billion in assets under management. What's also interesting is that, the bulk of that allocation is really from pension funds. So pension funds that either allocate via fund of hedge funds. So the fund of hedge fund element being the bigger part, just in terms of the allocators in this space, and then hedge funds.
And if you look at the retail market, you know, there's very, very little allocation to hedge funds, which I believe is really a lost opportunity there. So I mean, if you look at, like I said, the experience in the industry, the fact that it is indeed, like you said, a mature industry, there is regulation or regulatory oversight, and over and above that, these managers have a proven and long-term track record of successfully managing hedge funds in this space. So it really is a no-brainer for me that, you know, investors should have hedge funds as an allocation in a broader diversified portfolio.
Thanks, Busi. As I said, I know you're very passionate about this asset class, but as a business, I mean, we really believe that hedge funds have a place in portfolios. So thank you very much for joining us today and for sharing your insights with us.
Thank you, Monene.